Hello friends, how are you? I hope all of you are doing really good. So welcome to Economics of Finance Excellency batch. And what we have been discussing about, sir, we have been discussing about monetary policy, right? So what is this monetary policy? We discussed about that. What are the various instruments in the last lecture? What we discussed about was the monetary policy instruments we have to study, operating procedures we have to study in this lecture. So in the last lecture, we studied about the analytics of the monetary policy, the basics of the monetary policy, as well as the analytics of the monetary policy. So this is what we studied in the last lecture, right? Okay, so now what we are going to do in this particular part is we are going to discuss about what, sir? We are going to discuss about the operating procedures, right? Now, what are operating procedures? As I told you that operating procedures are basically the various instruments that are available with the Reserve Bank or the Central Bank of the country to control the money supply and ultimately the money demand. So it refers to day-to-day implementation of the monetary policy through the various instruments, that how you are going to implement the monetary policy through with the help of various instruments, right? So for this, the central bank can act directly using its regulatory power or indirectly using the influence on the money market as the issuer of reserve money. So that means you will have two type of instruments. One is the direct instruments, another set is the indirect instruments. Direct is through its power, right, that is bestowed upon the central bank of the country. The central bank has some special powers over the commercial banks or how to control the money supply, or it can be through the indirect means, right, of controlling the money supply. So operating procedure focuses on the operating targets and the instruments. So what is the operating framework? He says all aspects of monetary policy implementation. It comprises of three major aspects. One is choosing the operating target, that any variable which the monetary policy can influence with its action. For example, inflation, right? So choosing the inflation target, that is what he's saying, choosing the operating target, that how the change in the money supply will impact the inflation. Second is choosing the intermediate target, any variable which the central bank can hope to influence to a reasonable degree through operating target, that is economic stability, right? See, 100% stability the RBI can't say. Is controlling the inflation, yes, they can set the targets for in the numerical terms, they can set the targets for inflation, but for economic stability, they cannot set the targets in the numerical forms, right? In the numbers, that what is the amount of economic stability they want. But for the inflation, they can set the range, that this is the maximum range, this is the minimum range. We'll study about that, right? Choosing the policy instruments, that various tools which the central bank uses to influence the money market and credit conditions, for example CRR, SLR, LAF, etc., that at what time which tool is to be used, right? So this can be done by the RBI. After that, he says the monetary policy instruments. What are the monetary policy instruments? The measures taken by the central bank to regulate the flow of money in an economy is known as monetary policy instrument. That through various instruments, how they are going to regulate the money flow. The instruments of the monetary policy are of two types. One is the quantitative, journal, or the indirect. Another one is the qualitative, selective, and direct instrument. They affect the level of aggregate demand through the supply of money, cost of money, and the availability of the credit, right? So there are direct instruments and there are indirect instruments. These instruments are important from examination point of view, right? So these can definitely be asked in the examination. Clear, sir? Now, what I'm going to do is I'm not going to read from here. I'm not going to read from here. So, sir, what are you going to do now? Right? So, what I'm going to do is I'm going to explain each and every instrument in a simple one word, one line, right, in the flow diagram or whatever way. Just I'll tell you the crux, right? What does the various instruments do? After that, what you have to do is you have to read it from the book, right? All of you must be having the book. Okay, so let's try to understand what are the various monetary policy instruments. Those are available with the central bank, right? So we will talk about the monetary policy instruments, right? Monetary policy instruments. So as we say that these monetary policy instruments are divided into how many parts? They are divided into two parts, right? One is the direct instruments. One is the direct instruments and another set of is indirect instruments. Indirect instruments, right? So let's try to understand what are the direct instruments. Various direct instruments available are CRR. The second we will study about SLR, right? Statutory liquidity ratio. Then the third that we'll be studying is selective credit control. The third one that we'll be studying is selective credit control, right? Then what are included in the indirect instruments? Sir, indirect instruments, we have repo rate, right? We have reverse repo rate. Then we have the open market operations. Open market operations. Then further also we have a few, that is LAF is there, right? LAF is there. As if I show you that how it can be, LAF is definitely there, sir, right? Then what else can be there? Sir, see, the direct instruments are given as CRR, SLR, selective credit control, then repo rate is there, reverse repo rate, open market operations are there, then liquidity adjustment facility is there, then marginal standing facility, MSF is there, then market stabilization is there, right? So MSF, MSS, then bank rate is now redundant, actually bank rate is not there. So MSF and MSS, these two are there. MSF and sixth we have MSS, right? Then bank rate is also there, but nowadays the bank rate is not actually used, right? So these are the various operations that we can do, the direct instruments and the indirect instruments that we have to study, right? So we'll see one by one. We'll see what each instrument has to tell us. So the first instrument that we are going to do is, that is the cash reserve ratio. That is cash reserve ratio, that is CRR. Now what is CRR? The RBI says, or the central bank says to every commercial bank, what, sir? He says if you are getting a deposit of, let's say 1 lakh rupees, now out of this 1 lakh rupees, 10% of it, that is 10,000 rupees, you have to keep as cash with reserve bank, cash with central bank. Then some part of your deposits are to be kept as cash with the central bank. Now, how this helps in controlling the money supply? Sir, if the central bank wants to reduce the money supply in the economy, what will they do? They will simply increase this rate. They will simply increase the rate to reduce money supply. They will simply increase this rate to reduce the money supply, right? Because how the commercial banks create the money supply? Through the process of borrowing and lending. Now, if more percentage is to be kept as cash with the central bank, then the commercial banks will have less money for the lending purposes, right? Less money for the lending purposes means the reduction in the money supply. As simple as that, right? And the vice versa. If the central bank wants to increase the money supply in the economy, then they will reduce this rate, right? Clear? So what is CRR? It is the percentage of deposits. What is CRR? It is the percentage of deposits, to be kept with central bank, as cash balance by all commercial banks. right? So this is what is CRR. I hope there are no doubts in that, right? So this is the CRR, that this is the amount, and this is how the control of the money supply is being done through CRR, right? Now the second one is, if you talk about the second one is statutory liquidity ratio. Statutory liquidity ratio, that is SLR, right? Statutory liquidity ratio. Now what does it mean? What does it mean? He says that all the commercial banks, whatever the deposits they have, some amount of that deposits is to be invested in the gold or the government securities, right? So what the RBI says, if you are getting a deposit of, let's say 1 lakh rupees, right? So the central bank says out of this 10% is to be invested in 10% is to be invested in gold or government securities, right? So what is the impact of that? Sir, this money will not be available with the commercial banks, right? So this is the instruction to the commercial banks. This is to be done by commercial banks. Now, if this 10% is to be kept in the form of gold or the reserves or the government securities, then that means this 10% money is not available for lending. This 10% if not is available for lending, that means there will be reduction in the money supply. So if the central bank wants to further reduce the money supply, they will increase this 10%, right? They will increase this 10%, will reduce available money for supply, available money for credit purposes, right? So this is about the statutory liquidity ratio, right? You can write it down that it is the percentage of deposits to be invested, in gold or government securities, by all commercial banks, right? So this is about the SLR, that how the SLR plays the role in the control of money supply, or how it is being used as a control to money supply, right? Percentage of deposits to be invested in the gold or the government securities by all the commercial banks, right? Now the next part is, the third one is the selective credit control. Now if you, this was the second one was the statutory liquidity ratio. Now if you talk about third talks about the selective credit control. Now what is this selective credit control? He says selective credit control is the use of margins, to control money supply of a selective category, Now what they're trying to do is, they say, what is selective category? That means to a particular set of the requirements or the consumers, they will try to control the money supply. How they will try to control the money supply? That is, it is known as selective credit control. Now credit means the amount of loan amount which is being given as loan by the commercial banks, that is the credit. Selective means it is given to a selective category. Let's say the government says the home loans are to be made costlier, right? So what the government, the banks will do is, the instruction will do is, let's say I go to the bank to ask for a home loan, right? They will say, okay, we'll give you the home loan. We want something as the security. Let's say I say that I want rupees 1 CR home loan. The bank will say, okay, what is the security, what is the collateral security that you are going to give for your loan? I say, I keep anything, right, my jewelry or anything. He says if this security is worth, let's say, 1 CR, the bank says will not give the whole as the loan, right? If the security amount is also 1 CR, will give only 60% as loan, right? And 40% will be the margin money, right? This is the margin of safety basically, that in the case of default, at least 40% is safe, right? So he says we'll give you only 60%, the 40% we will keep as margin. So if they want to reduce the money supply in the economy, what they will do is they will increase this margin and reduce the amount of loan. But if they want to increase the money supply in the economy, then the reverse will happen. The margins will come down and the loan amount will increase, right? So if you want to increase money supply, what you have to do is you have to increase money supply, then you have to reduce the margin money, then you have to reduce the margin amount percentage, right? And if you want to reduce the money supply in the economy, then you say that more and more money should not be available for the credit. In that case, you will increase the margin percentage, right? So this is about the selective credit control, right? So you can read it from the book. I have given everything in the book, nothing to worry as such, right? So everything is given here, right? Repo rate, okay, the selective credit control is given, then SLR is given, then CRR is given to you. So these were the direct instruments. All these three were the direct instruments of controlling the money supply, right? So now we'll talk about the indirect instruments. So these were the first three were the direct instruments, right? Okay, so I'll name them direct instruments. Direct instruments, right, sir? Now the next that we'll be doing is the next part that we are going to do is indirect instruments. The next is what? Indirect instruments. So in the indirect instrument, the first instrument that we are having is the repo rate. All of you must have heard about the repo rate. Very common, sir. The RBI or the central bank keeps on changing the repo rate, and you definitely must have heard about it. Even if you don't know about it, you must have heard this word, sir. Repo rate and reverse repo rate. I'm pretty sure that you must have heard about this, right? So what is a repo rate? Repo rate is the rate at which RBI lends money to commercial banks. It is the rate at which RBI lends money to commercial banks. So what does it mean? Now there is one bank, let's say SBI, right? So SBI is having the shortage of funds. SBI is having the shortage of funds, right? So what SBI will do is SBI approaches the RBI, that is the central bank. He says, RBI, we are short on funds. Please give us some money so that we can do our routine operations, right? Okay, so they approach RBI and they want to take a loan of rupees 5 CR from RBI, right? Obviously, sir, it is the RBI's money. RBI say, okay, I'll give my money for the usage, but will RBI give it free of cost? No, sir. RBI is not going to give this 5 crore rupees free of cost. RBI will say, okay, if you want 5 crores, I will charge interest on this. I'll charge interest on 5 crores. SBI says, okay, sir, because see, commercial banks are the separate entities. RBI is a separate entity. Now, RBI says, if you are going to use my money, 5 crore rupees is the money of RBI. The RBI says, if you are going to use my money, then I'm going to charge interest. Why will I provide it free of cost, sir? Right? Okay, charge interest on 5 crore rupees. Now this interest rate, let's say RBI says we'll charge 5% from you. This is what is the repo rate, the rate at which the RBI lends money to the commercial banks, right? Now, how this repo rate helps in the money supply, sir? Now, if the RBI says the money supply in the economy is to be reduced, right? Money supply to be reduced, right? Then what will RBI do with the repo rate? RBI will increase the repo rate. Why, sir? Why RBI will increase the repo rate? What will happen, sir, if the repo rate is increased? Let's say it goes from 5% to 8%, right? Now, this borrowing by SBI will be at 8%. This is the SBI's cost. SBI will have to pay 8% to the RBI. So when this SBI gets 5 crore rupees at the rate of 8%, now what is the purpose of this 5 crore rupees? The SBI wants to lend money, right? Now earlier what happened, sir? The RBI was lending money, was getting the money at 5%, lending at 8%, right? So now now SBI is getting at 8%, so they cannot lend at 8%, sir. They will have to lend at least 10 to 11%, right, to earn something out of it. So what is happening here, sir? The lending is becoming costlier. Now people earlier to whom the SBI will lend, they will reduce their amount of investment because this interest rates have increased. So this is how the RBI impacts indirectly the money supply in the economy through repo rate. Clear? So it is the rate at which the RBI lends money to the commercial banks. Now the next part is, the second one that we have is the reverse repo rate. The second one that we have is reverse repo rate. Right? Now what is reverse repo rate, sir? What is reverse repo rate? Reverse repo rate is the reverse of the repo rate. Okay, sir. Very good, sir. Very good definition. The rate at which, it is the rate at which RBI, the rate at which RBI borrows from commercial banks. Borrows from commercial banks. Right? Now the situation has reversed. What, sir? RBI approaches SBI. RBI approaches SBI that please give me, I want to borrow 5 crore rupees from you. Borrow 5 crore from SBI. Sir, RBI can also be on the shortage of the funds. So RBI approaches the commercial bank that please, I'm shortage on the funds, right? I want to give it to the government for the various plans or for any purpose, right? Now, what is happening, sir? RBI is at shortage. When the RBI is at shortage, the RBI will approach the commercial banks. Okay. Now, SBI says, now it's the time for revenge. SBI says, I paid you the interest. Now, if I am going to give you 5 crore rupees, I will also charge interest from you. The RBI says, okay, there is no issue. The RBI says the rate of interest, I will decide. I am your father. Right? The RBI says, I am the central bank. I am your father. The rate I will decide. I'll give you interest, but the rate will also, I will decide. Right? So it is the rate at which the RBI borrows from the commercial banks. SBI says, okay. Now RBI says, I will pay you 5%. SBI says, okay, take the money. Right? Now try to understand how the money supply can be controlled through this. Now, if you want to control the money supply, if you want to reduce the money supply from the economy, what RBI will do? Reduce money supply from the economy. Now, what RBI will do in this case? Sir, in this case, RBI will increase the reverse repo rate. Increase the reverse repo rate. Sir, why? How, sir? Reverse repo rate. Normally, this is what is happening here, right? Increase the reverse repo rate. Why? Because the RBI says, now I'll pay you 8%. Now what SBI will do? SBI will say, instead of taking 5 crores, take 10 crores from me. Why? Because the SBI getting 8%. Otherwise, if SBI would have lended this 5 crore rupees to any person outside in the market, SBI would have got 7%. right? So now the SBI says, oh, this is a very lucrative rate. RBI says, I will pay you 8%. Why RBI is giving 8%? RBI wants to control the money supply. They want to take the money out of the market. So RBI says, give me 10 crore. I will pay you 8%. SBI says, why not? SBI says, why? SBI says, I am interested with the profit only. I am interested with the interest only. If I am getting 7% by giving it to a person outside, why not earn 8% by giving it to RBI? Right? So what SBI will do? SBI will now park the funds with the RBI instead of lending those funds. Right? So the money supply is reduced. The less of credit money is available, which can be lended to the outside persons in the market. Right? So this is how the RBI is using the controls. So this was the reverse repo rate. Right? Now the next one is the third one and the last one for this particular lecture. We'll continue it in the next lecture. The remaining part we will continue it in the next lecture, right? So the third one is open market operations. Third one is the open market operations. This is very simple. Open market operations. Now, if RBI or the central bank wants to control the money supply in the economy, what they have to do is they have to pull the money out of economy. Now, what they will do in the open market operations is the RBI or the central bank buys and sells. What they are doing is they will buys and sell the securities, from open market, right, to control money supply, right? So what RBI is doing is, if RBI wants to reduce the money supply, if RBI wants to reduce the money that is available in the hands of the public, what will RBI do? RBI will sell the securities, right? Now people will have securities, RBI will have the money. RBI is selling the securities and getting the money from the public, right? They will provide the good interest rates on that, so that the public is interested in buying the securities. The public says that we have the securities, we will get interest on that. But at the same time, what RBI is playing the game is, RBI is reducing the immediate money in the hands of the public, right? So they are reducing the money supply. So if they want to reduce the money supply, they will sell the securities, right? This is to reduce money supply. This is to reduce money supply. And if they want to increase the money supply, then they will buy the securities, right? This is to increase money supply. Right, sir? So this is the open market operation. So what we have done in this particular lecture is we are not going further, right? Because I want that all of you must read from the books up till this point, right? Everything is given in our books. All those who don't have the books, they can buy it from our website, that is www.ksjteaching.org. From day one, I'm saying that this is a very small investment that you are doing along with these lectures, and already many students have invested, right? All those who are watching, everyone has invested in the books, and if you have still not done that, you can do that. That is going to be really helpful for you. Okay, so what we have done is we have done 3 direct instruments, that is the CRR, SLR and the selective credit control, and we have done 3 indirect instruments, right? So what we have done is what we have done here, we have done CRR, we have done SLR, we have done the selective credit control, right? And on the indirect instruments, we have done the repo rate, we have done the reverse repo rate, and we have done reverse repo rate it is, right? And we have done the open market operations. Now we are left with LAF, MSF, MSS is there, bank rate is there, then one marginal standing committee is there. We have to discuss about that, the composition and the functions. Very easy, right? So in the next lecture, we are going to complete this chapter of monetary policy, and with that our unit will be complete. After that, only international trade will be left with us, right? So my suggestion is, what you people have to do is, you have to revise, you have to read from the book by heart, you have to understand each and everything what is written in the books, right? You have to do it whatever we have studied in this particular lecture, right? After that, we'll continue it in the next lecture, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.